Here we are.
Call to order a special meeting of the Board of Supervisors for today, June 11th, 2025. We'll start with the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you all for coming. We have, I hope we don't have any deletions or additions to the agenda since we just put this together today,
No, sir.
or yesterday rather. So we will move right into the subject. So presentations, the financing scenarios, we'll let Bob introduce it, and then we'll have Jamie from PFM.
Thank you, Mr. Chairman. Last Thursday, Jamie was here, gave a presentation on the cost to obtain a $20 million bond. The board wasn't quite sure if they wanted to do that or two other options, so Jamie went back, and tonight has three options and the cost associated with each of those options. Now, I'd just like to let the board know that there have been some fast-paced changes in the fire services, driven by the fire chiefs, that we seem to have moved up what would have been maybe a 5-year project for fire into the 3-year range. And that ties in directly to the police department for a couple of different reasons. So we're really here to plan for the future. And if there's no desire to move quickly on the future of those two projects, we really wouldn't have a need for a bond. We could pause, continue to build up our reserves, but then you're starting a 3-year process, maybe 5 years from now. If the board so considers to take this bond, we get a jump start on that. We stay ahead of our growth, and we keep the momentum going in the fire services. I believe I'm speaking for Fire Commissioner and Chief Stastowski when I say that, along with the other staff. That's just our feelings. And I just wanted the board to be aware of that.
And I think we'll be able to dive more deeply into those things with the motion process for tonight, and opening that up for conversation. I appreciate the preamble. So Jamie.
Thank you. So as I try to keep things as simple as possible, we'll just talk a little bit about what we're providing tonight to talk about kind of the dollars and cents of estimates. And I know last week was last week, but we're here tonight, so I want to talk about just what we've seen in the market most recently. I actually sold bonds the last 2 days for local governments, one school district, one local government, both in a strong credit position, not the best you can be, but they're the AA category, which is obviously way above investment grade, and finding investors was something we wanted to make sure we felt comfortable with telling you tonight. We sold about $10 million on Tuesday at Downingtown Borough. That was for municipal building projects tied to a flood that occurred with Hurricane Ida. Those were public works and municipal facilities. A 30-year transaction, a little back-end loaded more than what this would look like, but generally speaking, on a $10 million issue, the underwriting firm found $20+ million of investors that wanted to buy those bonds. So supply, demand, good to hear. Today's sale was with a Northeastern New York school district. That's a AA2 credit rating. They were just upgraded from single A. Pretty proud of that. They've done a good job of planning for some large capital projects for their high school. And in that particular situation, we were looking for a $22 million bond issue to start a $100 million platform plan over the next 3 to 5 years. In this case, we received $65 million worth of demand from investors, including all the big firms that you would think of: Goldman Sachs, Naveen, JP, you name it, they bid, which is good news. So, one of the things that drives all of this is the type of investors that want this are looking for stability. They want strength, stability, and that's what drives the investors that come to market. So we're hoping, as we go through this process, that will be the result, when the township decides to move forward. But I want to bring that up to say it seems to be clear. We're seeing good things, and we'll do our job as time goes on. In that vein, because of the conversation we had, I took a look at a few more different scenarios. We've obviously talked at length about projects that you're working on today, projects you're considering in the future, and the goal being having a strong, healthy, reserves once this is all said and done. And I think that's an important point here, because one of the things that I always think about when I sit on this side of the table on your behalf is you want to make sure that you're funding transactions that the residents that are either here today or in the future are going to cover paying for. And that's the concept of leveraging debt over a course period of time. And that's what it's all about. So in this case, we ran 3 scenarios, 20 million, 25, and 30 million. I'll give you a high level. As we talked about, there are various capital needs through your facility study. And again, currently you're working on the Lifestyle Community Center. Just to summarize, and you can see the actual colored sheets that we had from the pages you've seen in the past. If you borrow $20 million, you end up with a little bit more proceeds than that, just because of the way bonds are structured. When you borrow $25 million, you end up a little more than that, about $25 million. And then if you borrow 30, you end up a little more than 30. It'll be what it's going to be once the market hits. The thing to point out here is, and I've described this multiple times, but interesting bullet point here is number 7. When the rating agency, in this case Moody's Investor Service, looks at the creditworthiness of local governments, they look at all things, right? Demographics, financial history, transparency of the type of work that you do, and ultimately, your long-term plans. That is the conversation we have with the rating agencies all the time. Traditionally, the best credit has strong reserves. As described, right now, the township has a strong fund balance over 200% of your total revenues. And traditionally in Pennsylvania, the historic average is about now 91.2%. It was 98% about 6 months ago. So give or take, you're in the 90% range. So these are usually the bogeys I like people to consider when you're thinking about something like this, because you want to have those healthy balances. The better credit rating you have, if there's future capital needs, the lower the debt service you pay. So that's what we're striving for. So we use that as the backdrop. Frankly, the next few pages are really driving home, what we've kind of seen before, at least with the scenario concept. So scenario 1 is the $20 million issuance. Based on the structuring, if you do it, it's a maturity about 24.5 years or so from now. The annual payments would be about $1.48 million a year for the next 24 plus years. And total debt service is shown on the bottom in that blue section. So like everything else, you amortize debt over a period of time. You make principal and interest payments. You cover that, and as we talked about, you'll get deposited funds at settlement, which you can use toward the capital needs. I'll just skip to this next page, which is what we've been using as a basis for planning purposes. And this may not fall exactly in line with some of the estimates that you have, but we wanted to at least show you an idea of if you were to move on some of these projects over a period of time, and we started with a balance that I have a general thought of what your balances are. It may not be exact these days, but we started with a balance of $54 million, assuming the Lifestyle Community Center project estimates and some general estimates of what a fire station, police station, municipal building renovations are. Whether I'm high, low, or indifferent, I don't know. We'll get there when you get there, but call that another $40 million of capital needs, making the assumption that you have certain draws that come starting in 2026. And if the municipal building happens a little bit after that, should you choose to do that, we try to show what the cash flow is tied to covering the cost of those projects. Important to point out here is, one of the things we talked about last week is we're hoping you'll receive, post the finish of the Lifestyle Community Center, your $5 million grant. So that'll be shown in this model as well as any other external funds that you collect. If you look at the bottom of this, again, there's no major magic besides some estimates here. If you were to do that amount of money and you made all those assumptions, you would have a negative balance. So what we've talked about when you have the parameters resolution ordinance that we did last week, that gave you the access to borrowing as many times as you needed. Here we're just talking about doing one borrowing for $20 million. If you did no other borrowings and received some interest earnings on this and received your external funds, obviously it puts you in a position where you don't want to be. So that's at least shows you that. Turn to the next page or two. This is the example if you just went out and borrowed $25 million. Not surprising, you have $5 million more in your pockets at the end of this. Of course, the difference being you are amortizing that extra $5 million over that period of time. So instead of the payment being about 1.4-ish range, you're now up to about $1.8 million, almost 1.9, depending on the interest rate environment. So that's an example of that. Really flipping to the next page, I'm not going to beat the dead horse here, but same concepts, same draw schedules, same assumptions, except for, your deposit, is larger when you started. So which means you're earning interest on that from day one. You'll notice the bottom of that, estimate in 2029 shows a positive balance at the end. So that's probably, you do nothing else, you'll still end up with a fund balance, which is, I guess, good news without any, future other, operational revenues you're receiving. Turning to the next page is scenario 3. Not surprising, an extra $5 million on top of that, $30 million. Payments would be about $222,000 per year. Again, flipping to the next page, you just got a balance a little bit higher than the last. But those are the very simple scenarios. But I think what we're doing is looking at a holistic approach of all projects. Again, these are decision points that you as supervisors will make in the future. But making some of those assumptions, these are the kind of needs and cost and cash flows that would come from that. So I'll stop. Lots of numbers on pages, lots of estimates, but provided that. Bruce.
Jamie, just one thing. Those have 8-year call.
Yes.
So in 8 years, we could call, or can you refund at that point?
Yep. Yeah, you can do
All right,
both.
So
yeah,
those costs could go down.
Oh, definitely.
But you
That's
pay down
that's
8
the
years.
most you'll pay.
Yeah.
Is the best way to say it. Yeah. I mean, again, I've done lots of refinancings in my career, so
I know.
we would probably do it multiple times.
Jamie,
Just the way it works.
you talked about, I think it was the New York School District had a 30-year bond repayment. We're on a 24. Can you talk to me about the amortization rate and why 24 is better than 30, or if we can save money doing one or the other? What's the approach there?
So there's a delicate balance of the break even where the value of the incremental reduction of annual payments for cash flow fits to a point for districts versus townships. School districts have a cap on how much they're allowed to raise taxes called Act 1. Townships don't have that cap. So for purposes of how we planned this project, which started 8 years ago, we started borrowing funds then, did the second tranche now. They are raising taxes for them by about 0.3 mils per year between now and 2028. So we have to structure the debt in a certain way to allow them to fit within their cap for taxes. They have reserves. It's just a different situation. So I think we chose the 24 years because it's kind of in between 20 and 25, 20 and 30, 1 and 2. It's a useful life situation. You have a building that's going to be here for a long time. Our viewpoint is, affordability is good. And 2, if you choose in the future to decide to shorten up your debt, you can. So this just starts it off at a 20, that 24 plus year amortization.
Okay, so that 24-year amortization is sort of in part based on the fact that we don't have a cap. We could always raise the rates if the number gets too big. But to repeat, we are not having a conversation tonight about the tax rate.
We are not, but I'm pointing out, you asked the question about the school. That's their different situation.
Okay.
Yep.
Jimmy, I had a couple of questions. So I assume you're still making an assumption on a 6% coupon rate, right?
No. The coupon rate in real life will be probably between 4 and 5%.
4 and 5%. Okay. What did you see when you did these sales?
They were both actually the sale today was non-bank qualified, which means it was over $10 million. Traditional investors of non-bank qualified debt want coupons around 5%. So most of the issue was in the 5% coupons.
Okay.
We did have the initial years were 3% because there was $35,000 of principal that wasn't sold because it was $5,000 maturities upfront, and retail investors prefer more discount bonds upfront. So we made the adjustment for that transaction. Didn't make a big difference in the grand scheme of things, but that was just a concept of what we did to get the balances sold off.
So the model that you had during the last meeting, though, I thought it was at 6%.
It is. Your
Okay.
max parameters are 6%.
All right. And in this analysis that you did, it didn't show our budget surplus, right? So
This is just a cash flow for payment of construction projects.
okay.
I did not build out a long-term financial forecast for you. That is a different job, we'll call it.
Yeah, do we have that? That's kind of what I was hoping to see. Because I'd like to see, like, when you really need the money based on when we think we're gonna make the expenses, and time it, so that we don't have to carry debt, for a long time before we actually use it. Because if you're, and I'm just making a number to prove a point, if you're borrowing money at 6% and earning it at 3%, that's not a good financial.
We're not borrowing at 6%. I just want to
Yeah,
point.
no, but I'm making a number. I don't know
borrowing
what the
we're
number
borrowing
is.
Today's bond issue for Northeastern was 4.5%.
4.5. It's obviously higher because the banks are not in the business to
And
give
this
you
is
money
what,
to-
what are we
to
getting now?
invest at a
So
higher rate.
We borrowed at 4.5 and we're getting what, 4?
4.32.
440
Oh, you're 440?
between.
So it's
Look at
not
these.
that much.
So I'm sorry, I didn't hear you.
They borrowed at 4.5 and we're getting
440
four,
right now.
four,
Yeah.
4.4.
Okay.
So
If that's what I
that's
want to
not-
see, though, but
that's not-
I haven't seen anything in writing. I'm just.
It's coming.
It doesn't really put out a month by month, Sonny, because I don't know how the contracts might be awarded,
Okay.
how the bids might be awarded, when the construction can actually start, but I did put together.
I just
timeline.
literally got this like a few minutes ago. If you want to put up on the screen or something, we can
Well,
all
that's,
see it.
I think that's, I want to keep that conversation to the motion conversation because we're going to have Jamie answer sort of the generalized questions. He can't answer the specific ones for our cash flow.
Yeah,
That-
okay.
that
I'll
we'll
wait
put-
for you to present
We'll
make your
put
presentation.
We'll put Bob and the team on the spot then.
All right, that's
Yeah.
fair.
I'm
no
giving,
problem with
this is generally speaking, the way we traditionally plan for bonds is how the construction projects are done. And you've heard me say it probably 20 times, the concept of reasonable expectations to spend the money within 3 years is the general tax rule. So you have that with the current project you're working on, and you have a feasibility study, facility study that's shown the needs based on what Bob just said earlier, that there's some considerations here of moving a fire building project up. Again, fits all within the tax purposes. I make sure we follow that. The second piece of that is really just budgeting for debt service. I think I remember hearing from the last meeting, your annual surplus generally from the EIT and other outside revenues is between $3 and $4 million a year,
Yeah.
give or take. So for purposes of how you can handle the amortization and the debt service, we're within that range if you go up to the $30 million category. So I'll stop. That's a different conversation, but I want to at least leave it to the administration to add anything.
So other questions of Jamie on the presentation from the board, Jim?
No, sir.
Sonny?
Thank you.
The questions I have probably is going to be with Bob and his team.
Yep.
That's fine. Thank you, Jamie.
Anyone from the audience want to ask questions of Jamie? Yeah, Mike.
Hi, Mike Szynski here. I hear these great numbers on interest, right? So we're making 4.4 on our money now, borrowing at 4.5. But something doesn't seem right to me because I think we're looking at a long-term rate versus a short-term rate. So when you're thinking about the difference, it's not the right apples to apples comparison. You need to focus on your debt that you're getting into now is the long-term debt. We're in a reverse yield curve now at this particular point.
But the whole point is at some point the spend is going to happen.
Right.
So if we're going to be able to do what we need to do, it's almost inevitable that we're going to need to be here. So the point is that when we're talking short term, that's because we're only going to be sitting on it for a short period of time. But we will be sitting on it.
And just to be clear, we're asking questions of Jamie on the general presentation.
Okay.
We're going to get into
Yeah.
there's going to be a whole separate part, I promise you, on the motion about the number, and we're going to get into the math. But this is about questions about Jamie's generalized presentation. And then that's why Bruce is here. That's why Mike and Pete and all of the team are up here today. We're going to be able to respond to some more specific questions about the carry and everything else as we get through it. This is more generalized questions about the presentation.
Okay, so this I'll save this discussion.
Yeah, there's
Okay.
going to be more, I promise you.
Okay, thank you.
I want to hear what you're going to say though, but save it because I think that's where I'm at too. I mean, I think I'm with the
Because you
same
gotta-
stream of,
yeah.
I want to get that detail
We'll get
before
I
I
there.
don't
can
want
make
to
a
talk,
decision.
I'll
We'll get
save
there.
all that for later.
I got you,
Okay,
Mike.
yep, I'm with you, Mike.
Any other questions to Jamie about the presentation? All right, Jamie, thank you. Stick around just in case we need to borrow your expertise as we keep going through it. And I need to find my first page since I've lost it now. So we're up to, on the agenda, there's a motion to authorize. There it is. Motion A, authorizing principal amount for general obligation bond sale. It has Bob's name, but I don't think we need more preamble before we dive
I
deep
think
into
this is a board decision,
Okay. Really?
100%.
Weird. All right, so I would like to do this because I don't know the
I
amount.
think I'm gonna leave my amount up to Bob.
Okay, all right, full discretion. Is that
Why
in
why
the?
don't you just leave it without and then revise it? Because
So here's what I'm gonna do. I'm gonna throw out a number in the middle because the middle is always a nice place. And if we have to, we have to mend it, we have to mend it. So I'm gonna make a motion to authorize the township manager to execute all paperwork necessary to complete the sale of bonds in the amount of $25 million. Can I get a second?
I'll second that.
Thank you. Okay, so now we're in the fun part. So Bob, I'm going to turn it over to you and let you sort of run the team through some of the ideas here of what we touched on a little bit, which is some math, but let's dive a little bit more into the need here and what we're trying to do.
Well, I think the need is also a board decision on how they want to see the future of fire services in the township. There's also a concern, Mike can probably speak to the physical limitations within his building and the conflict, I guess it would be, between male and female officers, changing spaces, locker areas. He has a need. So again, hearing just May last month that from the fire commissioner that the chiefs have decided to move forward to a 1/1/2026 go live of basically a central station, a unified station, Station 57, for their operations, their policies, their procedures, the command staff, with the staffing program. Again, I provided the board basically a 3-year timeline. That is very aggressive, and probably someone will tell me that it's pie in the sky. So I'm with you, but you never know. So we could be looking at and my suggestion is we start in August. We've spoken with 2 architectural firms. We've got 1 estimate back. We're waiting on a second one. Hopefully by August, we could have some of those numbers nailed down a little bit better, but just going off the 1 estimate and knowing that we're starting in August, I'm looking at maybe in April and October occupancy for some of these buildings of 2028.
So let's do this. Pete, because we have to sort of do this in order because the fire drives the police. So Mike, I want to give you a chance to talk to us about we heard the Alloy 5 report of the station a few months ago. Pete, same with regards to the fire stations. So let's get to it about what the driver seems to be. Some things that happened in the last month, really 2 months with fire. Talk to us about your time frame idea, sort of what driving us forward quickly rather than the sort of slower approach we were anticipating before.
Thank you, Mr. Chairman. We are at a crossroads in the fire service with Upper McCundy Township. We have the old road and we have the new road. Over the last year, we have taken that new road up to that crossroad, and the board helped us with that. We started a staffing program at Fogelsville Fire Company. Staffing program is building, and we want to continue to build that staffing program. Fogelsville is a temporary location. For us to continue to be successful, we need to keep motivated. We need to keep the program moving forward for the fire service. We want to be the leaders in the Lehigh Valley of the fire service. We need a new building to do that. We have very motivated fire personnel from all 3 stations. we need to keep that motivation moving forward and to be able to keep succeeding with our staffing program. We need the personnel that are staffing for us and our fire service personnel in Upper Macungie Township need to know what our end result is, where our end home is. And that starts with a new building and moving forward to that path.
And also, Pete, I think it's important that that staffing program ties directly into initial response time.
100%.
They're out the door, and that gives the other volunteers, we're not discounting them or dismissing them. We're certainly counting on them to still be part of this process. But the idea of the staffing program is that initial out the door response, which is important to the community.
Okay.
Go ahead.
I guess, listen, I'm not disputing the need. Nobody's saying we don't need money. What I'm not hearing is how much we need, when we need it, and how do we make sure that we don't just, bring in money that just sits in the bank and there's going to be a gap. And the point that was made is we just don't know what interest rates are going to do in the future. So I'm only asking that we be a little bit more calculated in the execution of this. I'm not disputing the need. I mean, I voted along with you guys on all of those things and attended all the meetings, and I tried to do everything I could to get to this point. I'm just saying is that I'm not seeing a financial plan that tells me how much and when and for what. And when I say for what is it's going to be phased out. I
So
just got this, but I haven't. Let me just finish, please.
you did get something.
No, I didn't. I didn't get what
We all did.
What exactly did I get?
We got a study with dollar values.
No timeline there, Jim. And
There was a
and
timeline.
that study
The
is
timeline had the study had a
it's
timeline.
like 9 years. It's 9. I have it here. I brought it with
And
me.
he was saying 8.
It's 9.5. I have it here. I can show it to you.
So you
it's
did
through-
get something.
Yeah, but it's a spitball number, Jim. We don't even have architectural plans. How can you get a cost with
You
that?
can't, but that'll cost you 2.1 million, which I'm saying let's do in August.
Yeah, I get that, but like I said, how much? What's in our general fund right now? Bruce.
General fund cash.
Yeah.
At this point, 20. I think we're around $30 million.
So you have the money. You have plenty of money to.
Wait a minute. Wait a minute.
No, you don't.
That pays for our operating expenses.
And what community center payouts we have.
But that's so,
And that's ongoing. We can't rob that
okay.
to
But,
start a fire. The approach that we're looking at now.
so what I'm looking for is at least some cash flow analysis that shows. I'm not asking for anything that isn't done
About our-
in all companies. You have to know when you're going to need the money. I just don't know. That's the problem I have, and I just don't want to execute too quickly, and then have to pay for that cash because even though you're earning interest, you're not covering everything. That's where my concerns are. If you can show that to me, I appreciate it. That's all.
I mean, do you want me to run through the list?
Yes. Let's just run through it.
Well, show me what you got.
These are all notes. So again, they're estimates, Sonny, until you actually put something out and get a bid or get a formal proposal. We're just trying to get the numbers we can. August 5th, asked the board to approve a contract with a design firm for phase 1. That's to be able to site the buildings on the parcels, about $55,000. The one architectural estimate we got for design, which included architectural, structural, MEP, some contingencies, permitting, for both buildings was about 2.1 million. Might find one cheaper, but that again would be something that we'd come to the board in August with. It's important to get a construction manager on board pre-bid, during design. I got one estimate for a police department CM at about $2.3 million and the fire department at just under $2 million. Are we going to pay that all up front? No. But there are going to be some of those costs up front. Until we get the contract, until we know what their payment schedule is, I'm just telling you what the cost will be over the next 24 to 30 months. And it will, if the board so desires. That's why there's some assumptions here. It has to go through the planning process. I think HRG gave me a price. I don't know if I have it on here. Yeah, there is. Civil engineering. Police, about $120,000, which also includes a deed of consolidation for that new property on Citronia Road to incorporate it into Grange Road. So we don't have extra property lines and extra setbacks we have to deal with. Fire would be about $80,000. Administration building, if you look further down my timeline, I have that on hold. I'm not proposing we do that until we can catch our breath after fire and police. Barry Isit would need to review those plans. I think their costs were about $35,000 for the police department, $30,000 for the fire. Those are kind of the soft costs. Trying to get the building out for bid in February of next year, 26. Estimates, and the one firm we got the estimate from was one that Mike had looked at one or two of their stations and felt comfortable with their design. The architect's construction estimate is 18.6. So if we start awarding bids and contracts, we'll start paying that out April or May of 26. Fire station came in at 14.7 million. Again, if we can start doing contracts April or May. I'm hoping Public Works can maybe get in there in spring and help save on some of the site work costs. So I didn't fully put a budget number together for
Like
that.
they did on the community center. That
Exactly.
was huge.
There may be a $1.5 million salt storage building we'll put in there as part of the Public Works expansion. But that we'll probably try and finance. I talked with Scott out of our liquid fuels money. So that really doesn't impact anything we're doing here. Future building expansions over there, probably around $6 million. Again, I have those out April of 2028. By that time, my hope would be we got things under control. We know if we're building up our reserves. We know where our reserves are at. Those projects, maybe the new administration building, could be self-funded, but we won't know that until we find out how long is it going to cost, how long will it take to build these two projects, and how much are they actually going to cost. If you want to delay, it's just,
Obviously, look, it's a board decision. What I'm happy to see is that, I mean, I just got this, like,
I was out today.
Yeah, okay, so I didn't really get a chance to read it. I'm glad you did it. What I'm looking for, though, and I don't want this, it's just a Word document, guys.
Mhm.
What I'm looking for is an Excel spreadsheet. that
But
looks
Sonny,
like-
how do I know what month and what year are we going to pay out the 18.6 million?
Well, it can
I
be.
can guesstimate it.
You have to you can estimate it. You could do it in quarters instead of months because you don't have that level of granularity. But it helps us, I think, build a plan that lets you know, hey, when do I really need it? And instead of doing like a big bond of 30 million or something, maybe we go back and say, you know what, we might do two bonds of 20 or something like that, or whatever. Because then you do the analysis and you can realize what you really need and when you need it. And it may not, it'll give us, it will, we may need more money than this. I don't know, but it would at least give us a plan to march to. And even though it may not be perfect, it'll allow us to adjust because we have a plan to work with.
And
That's what I'm looking for.
And I had come to the board with 20 million last week. The conversation was, if we're doing it, we have the costs up front. We're going to issue the bonds. There's costs with that. We paid for our Moody's rating. There were incremental differences, about $500,000. The big numbers say incremental. It's the board, at least two, wanted to see what those other numbers cost. I probably wouldn't, from my professional and personal point of view, I don't think I would go more than 25 million, not at this point.
You know, I'm the numbers guy. I like to see it based on the numbers, not on hunches and gut feeling. I mean, that's kind of where I'm at, and I'm feeling it's more
I
like
don't think,
it's feeling
I
more
don't think
subjective.
this is hunch. The whole point, let's break it right down.
Mhm.
Either we're going to give our police and our fire a base of operations that we can grow with and serve the needs of the community, or we're going to deal with what we have. I don't know how else, because in order to do that, if we lose the momentum that we have right now with what's going on with fire, it's disastrous.
With all due respect, I said it
It's
earlier.
disastrous.
I'm not arguing the need, Jim. So you keep,
Okay.
everybody keeps on talking about, oh,
I
we
know,
got to
but
do it. We got to
but
do
you
it.
want
I'm not
him.
arguing.
You want him to do more, and I too don't know what else. He's
don't
not.
know.
You're not going to be able to lay a month by month spreadsheet out here and say this, because we haven't determined exactly where it's going to go, exactly how it's going to go, but we need to spend money in order to get to some of these places.
Yeah. Oh,
So if we're going to wait until we see everything before we get prepared to do what we're going to do, it's too late.
with all due respect, Jim,
We're losing.
I think there is more we could do before we agree on it. We could determine more when we think we need it. We have an incredibly professional staff here. I'm very proud of Upper Macungie and the staff that we have. We're fortunate we have that. I know that they're capable of doing that. I really do. And if we need help, we can hire a consultant. But this is done all the time. This is not something that I just came up with. I've talked to residents as well. I guess some of them are here that have that have worked on big capital projects, and we're all used to working that way. That's why I'm looking at this with some concern. And, it's not lost on me that this is a really big deal, right? This is the first time in the history of the township that we are going to be going into debt. It's going to impact us for the next 30 years. I'm just being a little deliberate on this decision because I want to make it right. I want to make sure we got it right. And for me, I want to see more data that actually lays out, hey, where are we that financially, Bruce says, hey, Sonny, this is absolutely, this is the trigger point. Can't go less than that. And maybe we pull up a little bit for a safety margin or something. That's kind of what I'm looking for, but I'm not seeing a spreadsheet that actually shows me that. It's just text of what we need, but it doesn't say when we need it. And it doesn't see what our balances are along the way. I'm just looking for something that actually shows me numerically shows me the trigger. And I think you understand what I'm
in New
at,
York
right?
City.
Yeah.
We're talking jobs now that they capped it, but $800 million. They cannot award a job unless that money is there. Those take 10, 12 years. There's a reason for that, Sonny.
We're not New York City.
It doesn't matter. The rationale is there.
Well,
If we're going to start a project, okay, we need to be able to get to the end of it, especially if it's for critical services to the township.
do we have enough? I mean, do we or do we not have enough money to finish the community center? Because I hear two different things.
Yes.
No, you don't. You never heard anything other than yes.
Okay. So we have. If we didn't get a bond, we could finish it with all.
Yes.
Okay.
And Jamie's presentation about running out of money was if we did the 20, or if we didn't do anything, we can't build the $18 million police station, whatever the numbers are, $15 million.
Hold on. The books are open to you. Go look for yourself. Don't take our word for it.
Yeah, but I'm not.
Go look.
I mean, that's the syllogism.
It isn't silly because
we have staff to do that. I'm not trying. I'm not taking away their work.
So let's do this. Let's ask.
I'm not saying that to be. I'm saying that because don't take the word for it. That you can go look.
So let's do it this way, Bruce. If we don't take the bond, and we're not spending any money on this project, so it's just the community center that we're building, which puts us out to a year from now. What does our general reserve fund look like after paying for everything, not counting the RCAP money that should be coming back, that'll probably be coming back in 27, the way the government works, not counting the donations that we're getting through the community fund. But if we just build the community center and nothing else capitalized, what does our general fund look like at the end of that?
That's what would be including the RCAP. So we just 5.1, but that includes the RCAP. But it also includes a debt service of 2 point.
That's assuming the bond?
Yeah.
What about
No.
any money from,
Wait, so I'm not sure it was said loud enough, so I want to be clear.
Well, no, wait till
Yeah.
they're sure about
That's,
where they're
I
going.
want to get the answer right.
Right.
So
I'm looking for the.
It was
the
one-
debt service.
It was one on what, 20 or
One-
25?
1.8.
Okay.
1.8. So about
That's it.
3.5 million
that's assuming that we don't have, that's with the RCAP or without,
without.
right? So that's, doesn't count the 5 that's coming in RCAP, I think, or 4.5, whatever the number is. It's not counting any additional contributions or donations that we can get from the community fund to service our, to help with debt service and help with repaying us for the community.
Is that even in there?
so 3.5?
No, the contributions from the founding partners aren't in there.
So it's 3.5 without the community,
Without anything.
without anything. Okay.
And you got to count the RCAP of 5, and you got to count roughly $500,000 yearly for the next 8 years.
So all I'm asking,
Let me finish my
Go
sentence
ahead.
first,
Go ahead, I
please.
apologize.
So if we don't do anything, and we have, RCAP's not coming till 27, most likely, because we don't get it till it's finished, and then it goes through the,
Well, not exactly true.
when are we getting it? Maybe 26.
Hopefully in 26, if
Okay.
not early
But
26.
without it, we can build everything and still have $3.5 million. What I've heard from Jamie, and correct me if I'm wrong, if we come back to the debt table with, instead of 40 million, we come back with 8 million. Our rating is different, our buying is different, our rates are different, and things change.
Yes.
So using your expertise, because of the way that our fund sits now, as opposed to a month, a
It's our
year,
book.
as our book
Where our
looks
book
now,
is right now.
that's where the coupon rate and the companies battling over our bond become. And so that's where some of the impetus to act now is.
Yes.
It's not acting now because the money we can use, we did the look back ordinance, we can repay ourselves for the last 6 months of community service bills. Is that right?
Yes, you can go 6 months prior. You did it in November, so you can go 6 months prior to that.
So we'll be able to use from whatever, if we approve a bond tonight and it's given to us, from Thursday, it made it sound like maybe early September is when we receive funds.
You would get it in
October.
July. You get it at the end of July. early
Okay,
August.
so even the next month,
Next month.
we can then pay ourselves back the roughly $8 to $9 million we've spent on the community center in the last 6 months, further enhancing our book, giving us the flexibility to do the spends that we need for the community center without hurting our bond rating. If we need to borrow more for more projects.
Yes.
But it's capitalizing on our situation now, which is important.
It is always better to go to a bank to get money when you have money, right? It's whether you're a person buying a car or you're a township looking to issue bonds. So the credit worthiness of the township is tied to historical averages of what you have, but they also look into what they think you're going to have in the future. And they were pretty specific on that when they're asking
Mhm.
questions about potential spends of other capital needs. We were very clear on potential alternatives. They weren't finalized. We were very clear on that as well. But they left the phone call saying, we're taking in everything into account. When you look at your numbers based on 23 audit, you guys are great. You're fantastic. You look great. But they also want to make sure they're looking at long term. So to your question, yes, you want to have reserves when you're going to rating.
And to Sonny's point, to be clear, if we did this bond in a month from now, we're not going to go from 40 to 10. If we did it from a month from now, we're at 40 to 35. You still think we'd be in a good rating spot?
Yes.
Okay.
Yeah. The where I was driving at, which is like everything else in this world, is seeing what we're speculating on where the market will be in the future. We always want to be conservative and be thoughtful of what you're trying to accomplish. And we saw what happened a few months ago, and we want to make sure we're not in that position in case something were to happen. I mentioned earlier about the most recent transactions that we did. We've done plenty since prior to that. It seems to be a solid market for investors that want strong credit. So we want investors that get you better rates. What I don't want to have happen is, I remember 2019 when Lehman Brothers collapsed, and a AAA township that I work with in New Jersey was looking for a 1-year note and got no banks to give them money. I'm not trying to fearmonger you at all, but liquidity is a thing, and it happens. But I want to make sure we're putting ourselves in a good position, both credit rating wise, from a planning standpoint, and ultimately from a safety standpoint. You want to know what your payments are going to be, and this gives you a good idea what that would be based on today.
And I'm going to monopolize for a few minutes because I'm going to ask a couple other questions. So, Pete, based on what you said from a fire service perspective and your perspective as chief of the fire services, we need to get moving now. And even if we wait a month to sort of announce our intentions, we run the risk of delaying a month, which runs the risk of not building on the momentum that the staffing program has given the fire services now. Am I correct in that?
That is correct.
And Mike, your turn now. How bad is the situation from your perspective at the fire station, and can we afford to wait? Police station, can we afford to wait? Or in your opinion, based on your morale, your staff, and where we're going and hiring and everything else that we're going to have to do as this township continues to grow, give me some idea of the expediency and what you need quickly and overall, if you can.
Well, some of our situation is like currently I have 2 desks, 2 officers, in really a 1-person office. And that includes changing facility in that office also, because our locker room, we don't have any vacant lockers. I have another office that has 5 officer desks in it and 4 lockers in it. It's a situation. We could have a sergeant at a desk right now correcting reports or doing supervisory responsibilities, and officers are literally changing in front of them for shift. Right now, those are all male officers in that office. There will be a situation where there could be some vacancies in that office, and that creates a whole nother level of concern since we have both male and female officers. Those are some of the big impacts, just spacing. After this year, I'm out of space without maybe a temporary construction trailer outside for lockers, which creates a whole nother space situation with parking. So we are out of space, and like Alloy 5 says, our building's obviously fairly new. Structurally and mechanically, it's pretty okay. For our processes that occur daily, I'm not sure what or how the planning went into that building and the layout, but it doesn't function efficiently or for the needs now or the future.
And to
How
be
about the armory and the safe?
The evidence room, we're okay right now. The armory is not ideal because there's air conditioning equipment, a lot of moisture in our armory that we have to have a humidifier or a dehumidifier in it. It's far less than ideal.
And you're anticipating, and I'm not holding you to it since it's June and not October, you're anticipating requesting funds to hire at least 1 additional officer next year?
For 26,
Yeah.
possibly, but I don't know where I'll put them.
So future hiring to make sure that we have enough staff to serve the growing population of Upper Macungie, in part, is limited by or could be limited by the space that currently exists.
100%. We were out of space probably years ago when that building was constructed. It was really constructed for exactly what we started with in 2013. I think we started with 28, and I think really we were at capacity at 30. We're now, by the end of this year, we'll be at 35.
Okay, so we're already over capacity. We're potentially limited to making sure that we can get more staff on board by the current space limitations.
100%. We would not be able to fit any more lockers without some sort of temporary locker room,
Which is maybe something you're gonna have to ask us to do. No
right?
matter.
A construction trailer or something.
Okay.
But like Sonny said, we're very proud of the township. We're proud of our services, both fire, police, parks and rec, and public works. And it doesn't line up with, I think, the needs and the expectations of the township right now.
So I know, Sonny, you said you're not objecting to the need.
No,
But
not at all.
But at a certain level, it's important to express that the need is not a generalized need. There's an expediency to the need.
Sure.
The need
Like-
is not that we might need a new fire station in the next 10 years. It's that we need to have it for the morale of the people that are helping us now, and to keep the momentum of the department moving forward. We need it to start now. And if we start that now, we can start the police station now, because we can't wait 3 months to do it, because that's just pushing us back 3 months. That's pushing us back 6 months in a situation where we already may not be able to hire anybody else now. We need to start moving now.
Sure. We could definitely anticipate a need for increase in our services within the next 3 years for sure. The township continues to grow, and it grows because of what the township is and what it provides.
Sounds like it would take about 2 to 3 to be able to give them a building anyway.
Yeah, I mean,
2, starting now.
I estimated April of 2028.
So it's 3.
And just so it's clear for the audience, because I think we sort of half mentioned it, but we didn't fully really go through. The idea, under the current idea, is that the land that the township just acquired that's on the corner of Citronia and Grange, combining that with a lot that we already owned on the corner of Citronia and Grange, and the new police station would be located there, right next to that's 78 there, isn't it?
222
The
by.
222 bypass over whatever it is, ramp, overpass. That's the word I'm looking for. We would then use under that model, we'd use the existing police station to construct the new fire station out of the existing structure, try to save some money, but it's a renovation, refit, retrofitting of that.
A renovation and retrofit versus a new construction. Because
Say-
we did look at renovation and expansion of the existing police department. But as Michael mentioned earlier, the 2-story flow and the separation of officers, command staff, investigators, interview rooms, there's a lot to that building that just doesn't meet the needs of the police department.
Okay.
And ironically, or I guess it's a benefit, it really lines up with Pete's needs. It's kind of scary how well it works, with the exception of the engine bays.
Which is, there's obviously for the number that we're talking about, the roughly $14 million, I thought it was, for the rehash. It's not perfect, or else it would be a lot less than that. But so the central fire station would be on this ground, sharing the township building for the time being until we figure out the next step for that. Police would be an all new location. That's something that's been discussed with you and approved by you guys beforehand. Yeah?
Yes.
Okay. So it's not just a need, it's an expediency of need that I think is important to emphasize, that from my perspective, and not just a political, but also just someone who's been involved in these conversations for the last year with a lot of the fire team, we need to continue to keep showing that we're moving in one direction. We can't stop now, because every time we stop, we get 19 different rumors, and we have to start from, we got to take a half step back to take the 2 steps forward. I am really focused on trying to make sure that we are only taking steps forward here, all in the eye of making sure that our residents are best protected as quickly as we possibly can do. And Chief, your team that is making do with what they have, it's fantastic. And I think we say enough, but not enough. Thank you for what you guys do, and working with what you have to keep providing everybody safe. And Pete, to the team that I say all the time to, I think, and if I don't, I should say it more. Thank you for what you do. We want to make things better for you, and I think we got to keep moving forward to do that. So I'm a little bit concerned that we don't have a specific timetable. I'm a little bit concerned that maybe a month from now, if we authorize these, it might get cheaper. But I'm also concerned that if we don't do it now, we have paralysis by analysis. We keep thinking of waiting for the right date and the right date, and the right date never comes because we missed our chance. And I think to what Jamie said, having money in the bank means we can borrow more money. Being able to repay ourselves for the community expense, keeping our general fund at a level that's generating the interest that can help pay the debt service, if nothing else. Giving ourselves options and the freedom to move forward on these things apace rather than let's take 2 months, let's look at the budgets, and then come back and have this meeting on the 3rd month, and now we're 4 months behind. I think that I don't need, for me, a specific workout plan as much as I need to tell Bob and his team, go, and I need to tell Mike and Pete and your teams, we're going. I think that's more important from where I sit. So that's just where I am right now.
And with all due respect, I think it's the definition of it that I want it better defined. It's like we want to do it now, but what is it? And that's where I'm at. And I'm just looking for more clarity on the amount and how it should be timed. I'm all with you guys on the need. I've never disputed that, and I'm very happy with the way that things are come together, and that the fire companies are ready to go. Nobody's arguing this, right? I'm with you on all of that. My only concern is I'm looking for something a little more of a financial plan to define the it and the timing, so that we go in, we don't have to do it again, or we didn't carry too big of a bond, because we're never going to make money on the money there, because you're always going to be paying. You're going to be paying more in interest than you're earning, and that's short term. If interest rates go down, which they could if we go into a recession, we're not going to cover it. So my only concern was I want to see a better model. And you have some of the information here, but it hasn't been put into a financial plan yet. That's all I'm looking for. And I'll yield the floor to you, Jeff.
No, I'm irritated. I'll reserve my,
I'm less concerned with the format than what's contained in it, Sonny. And I think
and I concur with that statement. Thank you.
if Bob's telling us through this and presenting to the public, which is, now we get to hold his feet to the fire. The idea is that we could potentially be authorizing a spend for architecture plans of $2 million within the next 45 days. It'd be nice to have that $2 million in the bank, that we're not spending against the general fund that is going to get hurt from this capital project, which was intentional.
Mhm.
And we took on a big bite, and because we could, and I think it was important to do it this way. From a supervisor and a steward perspective, I feel better authorizing those funds, those initial spends, and what's in Bob's plan that we're going to be authorizing on August 5th, if everything goes to plan. Us authorizing a bond and a number, whether it's 20, 25, or 30 tonight, or 60 if we want to be super crazy, but authorizing that is the forceful follow-up to telling Bob we're going. It's that we stand behind because we want to have the money to spend. We don't want to have to borrow it 2 months from now and wait. I'm ready to go, and I want to make sure that a fund balance stays above 3 while we're doing this, because that starts to scare me a little bit.
And Mr. Chair, we did have a healthy balance, but we spent years preparing for it, for that community center. That's been talked about, Scott, 20 years, 15,
You've been
18.
putting money away for
Right.
a while.
That is an option for the board to sit, wait, and build our reserves again. I'm presenting staff's concerns on a timeline.
Yeah, let's push it out to the public. And Mike, I know you wanted to make some statements about it. So if you want to go first, Mike, come on up. Otherwise, if you have something you need to say, just throw that hand in the air and we'll get you. You don't have to dance like you just don't care, but put it up anyway.
So I don't think I hear anybody disputing the need. And I think it is a legitimate need. It's really the timing aspect of things. And it's the projection of what is the, if you waited 6 months from now to do the bond issuance, what will the rates be? Will it be lower? Will it not be lower? It's kind of a gamble at this particular point. Okay, you know where the rates are now. I know there's turbulence in the market, especially with the tariffs, right? Okay, so we have that. It's kind of starting to settle out a little bit, but you never know what's going to happen, right? And I hear you say, Jeff, it's nice to have the money in the bank. It's not necessary at this particular point. You can continue on going and doing your plan as you continue to go, invest, get some better estimates, get more people on board. As you go through the project, you'll have a better timeline of when you're going to spend money. You're going to have a better idea of the money you're going to have to spend. And then at that particular point, when you're at that particular point, that's when you issue, and that would be my particular opinion. Nobody's disputing the fact, and I know there's some momentum now, and nobody likes to put the brakes on things for the momentum issue. But I didn't recognize, and I now recognize why Jim is saying, okay, what's the marginal rate between short term? Okay, yes, it is a short-term decision because you're deferring the issuance, whether it be 6 months or 9 months, a year, whatever it is. It is a short-term difference. So I respect that. I didn't appreciate that initially. So, but it's the issue of, it's a big decision for the township. I'm really proud of the Upper Macungie Township. The police, the fire department, the new community center, everything that we're doing here, it's the best township in Lehigh County. And it's also got the lowest tax rates in Lehigh County. And why is that? Because we didn't go into debt. We were prudent. We have a great public works department. They do a great job in money spent, okay? Very prudent. They saved us a lot of money on the community center. We ought to be proud of where we are. My concern is that if you put a bunch of money in the bank, it's easy to spend faster. You don't have that same, how would I say, stewardship that I'm proud of here at Upper Macungie Township. So my concern is if you issue it too early, you may not have the right number. You don't have to stop anything that you're doing right now. Continue on full steam ahead. But
Sorry, Mike, but that's what Jamie's saying. If we continue full steam ahead and then go for the bond 6 months from now,
right,
our credit rating won't be that good because we'll have spent down our reserves below what.
but Bob, if you're going to be issuing a bond, they're going to look at what your future spend is going to be. Okay, it's not how much it may impact where you're starting from, what you have in your pocket today. But if you're going to be spending $14 million on this and $18 million on that, that's going to be weighed into your credit rating.
Like to hear that. Jamie, what's your?
Yeah, the rating agency, we are transparent on what our future capital needs could be. That is.
Oh, Mike, I didn't mean sit down.
Yeah.
No. Come on back up. It's all right.
Yeah. So, I mean, they do look at the today's
Sorry.
audit or 23 audit. They were asking questions about what 24 was going to look like. And they were, very clear about what are your expectations for, reserves at the end of the year? What are your expectations of some potential capital coming down the road? So yes, they're going to surveil you for the next 20 plus years because their job is to make sure that the rating that they offer today is going to be good for the next period of time. So I'm not disagreeing with you at all about the stewardship of the township of how you spend and why you spend. I'm certainly not saying go spend $400 million on a bunch of random things. You want to be good stewards one way or the other. What you want to do is be smart about it. And I think the township's done a fantastic job of building up. The rating agency analyst was very excited to have a conversation with us. You heard them on the phone. They talked to many townships in this area and school districts in this area to hear about what you have and how you do things. It is a unique place, both on manufacturing, industrial, and location. That is a big change in what has happened in Pennsylvania. It has been a driving force of why we believe you'll be credited very, very well. no different than your neighbors up south. South. So the expectation here is, yes, we want to be smart about it. We were upfront about potential capital needs. We did not have the exact answers when we got on the call because we're never going to have the exact answers until you formally go through the process. But we were very clear that there will be potential thoughts of new capital outside of what is currently being done.
So it's really an issue of timing. That's what I see the decision here is not that you're going to do it, but when you're going to do it. And do you have enough information? Have you looked at all of your, what is our growth projections? We're going to end up with more growth over the next years. That's going to increase our tax revenues, right? We need to look at the total financial plan and picture for the next couple of 5 years and figure out where we're going to be. I don't think I hear anybody saying stop what we're doing, right? I think you guys are all aligned to that. I think the township, all the township staff is all aligned to that. Let's continue to do that, but let's just be prudent as far as when we go ahead and go to the banks and get the money and make sure that we have as strong a plan as you possibly can. And I don't think you're going to find that your interest rates are going to go much, much higher because you've waited. You already have this in your plan. My opinion.
Thank you, Mike. Appreciate it.
Thank you very much.
I can give one context from a year ago.
Sure.
A year ago, rates were 3.5%. We're now 4.5%. We've had cost of projects go up. I mentioned earlier about Downtown Borough with their building that they did. They borrowed money in 2022 to start the process to do those projects. That's when IDA happened. They borrowed $10 million more because the cost of the project went up 3 times as much. Now, they changed their scope slightly, but that is one of the risks you have. I talk about bond debt, interest rates, and planning for debt service. The big cost of this is the expectations of inflation associated with the cost of the building itself. That's what drives the borrowings we're going to do, or you could do, and the cost of the project. So I've seen it happen where we wait and wait and wait, and now you have a cost of a project that is much higher than you expect. We could be wrong, and the cost of projects can go down. It's been a ride up for a little while now. So again, trying not to be a fearmonger here, but I want to give you real life examples of what has happened with local governments who have done this.
So for sure, even being prudent in Mike's terms, and this is kind of where I guess I'm looking at it different, and perhaps Jeff is as well. We got a $4 million spend really within the next 6 months. If we want to move on the plan we want to move on, got to get architect on board. We should have he's right, get a construction manager involved early. And from those estimates, so to even keep the pace and be prudent. Okay, so we're not talking 15 or 20 or 25. We're at least talking $4 million. That is, if we're going to stay on this track.
No,
I don't know. I don't understand. So
there's nothing. I mean,
I understand trying to. I mean, we're there's no doubt that nobody can say it's going to be 18.2976 million to do this program. But here's what I can tell you: it's not going to be 5 million, and it won't be 60, but it's probably going to be in the range that he's got here, because that's what he did. And in order to keep that on task, on time, on task, and to keep the momentum, this is in my eyes somewhat prudent to do what we're doing. Now, you want to do it in 5 hits? How many hits? At some point, I don't know what that does.
To be honest with you, I don't know what, what's that?
Yeah, each time we have to get a new rate and call for a new bond,
Yeah.
it's
Yeah, you're paying rating more, you're
$60,000, but
paying, yeah, you're paying cost of issuance.
Which is the cost, I mean,
This, I'm,
and that isn't, sorry, that isn't insignificant.
well, let me respond to all your comments, all right?
It isn't.
no,
Well, it's not all just you.
So,
It's the overhead,
because I think, no, again, I'm not disputing the need. I'm not saying we don't want to do a bond. I'm just saying I don't think we haven't analyzed exactly what the right number is. And I'm hearing, but we just don't know all of the things that could happen. But all I'm saying, my response to that is that happens. Nobody knows, but you always put a plan together based on the best you know, and you list your assumptions, and then you move forward. And then if your assumptions you change your model, and you adapt.
okay.
I'm not suggesting, that
You missed my point. You missed my point. We have a spend coming up to stay on target.
No, I got your point.
I'm sorry, I can't see him with you.
No, I got your point. I'm not defining.
Well, and then what happens?
Jim,
Are we?
you're not missing. I think you're not getting my point. I guess I'm not communicating well enough. But all I'm saying is I'm not disputing the need, and I'm not saying that we don't need a bond. So I just don't have enough information here to even know what the amount is. We have 3 options on the table. I have not heard any discussion so far as to
3
what the right
options
option is.
Oh, we haven't gotten to that point yet.
But
No,
that's where we're going to actually
No,
end
but-
up. That's
but-
where the discussion is really
but
headed.
but at the end of the day, all of those options require a bond or funding of some sort, and it will be substantial,
I'm not disputing.
and
the
it's
need
going
for-
to be in somewhere in this range.
I think the disconnect is Sonny wants to move to how much? Because I think we have 18.6, we have 14.7, we have a 24 to 30 month timeline. I think Sonny wants to know how a $20 million borrow as opposed to a $25 million
Yeah.
borrow as opposed to a $30 million borrow fits within our budget to say what we're going to have at the end of these 2 things with the borrow. Am I right?
Yeah, I mean,
Which
Jim, you're
hold on.
completely missing my point.
Let's
And
not,
I
let's
wanna-
not- let's
But
not
we-
go backwards between each other.
Yeah,
we have.
no, I'm going to answer your question, Jeff, if you allow me. What I'm suggesting is, yes, I'm asking for just a financial plan so we know how much and when. And that's what I meant by we need to define the it. And you said, well, we need to move forward with it. I'm like, yes, I agree. But we're just throwing out scenarios, but we really haven't come up with an analysis that says, here's the right number and this is the right time.
But in order to
and
get to
that's-
some of the right number, we didn't know what the right number was on the community center till the contracts were out and the bids were received.
That's exactly my point.
Okay,
And we
but
don't-
we spent money, we spent millions to get to that point, millions on the community center. We moved way ahead of knowing that. We had to,
We had the money in the bank. We could do that.
which is the point. You
But-
just
But
made,
the
Okay,
difference
I'm
is we
done.
didn't have to pay. We didn't
I'm
have to
done.
pay a bond for it. We had the money. There was no debt.
I,
We're in
I,
a different
I-
situation now. We have to carry debt.
I understand,
and
but
that's-
that doesn't change the
All right,
need.
So let me
Nobody is arguing the need. I've said I don't know how many times I've said I'm not
Okay.
arguing the need.
guys, hold on for a second. Let me see if I can help. Bruce, if we took the motion on the table is 25. If we took the $25 million bond over 24 years with the amortization of the debt service that it is, with the current the current fund balance and the anticipated cost that Bob put together, of it looks like $33.3 million to build these 2 buildings, outside of the other soft costs, where are we 3 years from now?
So let me just kind of rephrase what you said. We got to start somewhere with, now or later.
Yep.
As far as our fund balance.
So let's start with the fund balance now.
So we figured that we were,
Take your time, Bruce.
well, I'll just preface that Michelle did a great job. Michelle did the lion's share of this. And
I know, but take your time. with what
it does
you're
take
doing.
time.
So I guess we can work with the fund balance now. or we can work with what the fund balance anticipated to be after we pay for the community center. But just for the sake of the conversation, let's assume where we are now with an estimated what we have left to pay for the community center, take out anticipated grants or anticipated monies, because we have to remember that there is state or federal or both money available somewhere for building a police station and a fire station. We're not going to have to take this on our own, is my best guess. Much less if there's another RCAP round, much less if there's something else. So just on a naked picture, you didn't think you were going to get racy tonight. We have, how much are we spending on the community center? If we added 25 million to that and subtracted out these costs, where do we sit?
$25 million issue, you're saying?
Yes, please.
Okay. And we have roughly 34 million to spend on the community center. What's left?
Okay.
Okay.
Everybody here okay?
Sorry. I can't hear, so I don't know how loud I am.
Yeah, let's drag that microphone close
And
to you.
then the spend that we're gonna have for the two projects,
Yep, it's about another 33.
33. To 67, 25,000. $42. So between what we have to spend,
I'd feel much better if you had a notebook computer with Excel up here.
I mean,
So
And the spreadsheets
just
were
keep
doing
going.
math.
Let's just
Go
keep
ahead.
going.
I'll just say, yeah, we're gonna fund 25 million. We have 34 million to spend yet, and we're looking to do 33. So that leaves 42 as a deficit. And our fund balance right now, well, I'm gonna back out the 25,000 because that, our 25 million, because I have a fund balance calculated through 12/31/26.
Okay, and
All
then
right.
and the fund
Right.
balance at the end of
That
next
was
year.
roughly 3.1 million we had come up with.
And at the end of 12/31/26, we've paid all of the community service expenses.
Correct.
We have not
No,
been
no proceeds at
we
all.
don't have an assumption of the RCAP money. built into
Correct.
that. We
Correct.
don't have an assumption of the roughly $500,000 we're getting over the next 8 years or more from the community fund. So that 3.1 is just a raw leftover dollar.
Right, exactly.
So then we add 25 to that, gets us to 28, and then we're subtracting over the next 3 years another 30, so we're in the negative numbers.
so, with all due respect, I mean, we shouldn't be doing this now.
When
It's
you
just-
keep saying all due respect, it means you're not saying other things with respect, so just cut that part out. Just talk with respect all the time.
Okay, speaking with respect all the time, I think what we're trying to do here is what I'm asking, but I think we should do it, not here in a
With Excel.
public meeting. What I think we should do is, and then you also should put in the the surplus that we get every year because we're running a surplus. So, that's not lost on me too, that we'll where we are now, we will catch up, That's all I'm asking. I'm just asking that we put it all, I don't want you to do it now in a meeting here.
Can also
I'm
call a
looking
vote. No, I didn't mean that. I'm just saying, that's
Community
Well-
comment. Oh,
all due respect.
Thank you. I just have a question. I'm a little bit confused and I just want to clarify. So with this bond issue, we're potentially looking to get $9 million from the bond proceeds to repay ourselves. And that's this year spend, right?
we could start that now. That's part of the look back ordinance that we passed.
And then in approximately 2 years, we're looking at 18 million for the police station, right? Because the fire station can't really start till the police station moves.
Well,
Ish.
hold it. What we're talking about is in 6 months to a year, we'll probably have 4 million in funds to get to where we could
Right,
spend
right.
18.
But
So
I wasn't
there's some
even-
leading up to the.
I wasn't
Go
even
ahead.
getting into the,
Go ahead.
the schedule. What I was just trying to understand is,
Well, it's not 8, I have 10 million for the police station.
That's in that. Using Bob's number from today with a reasonable estimate, you got 18.
Oh, okay, I'm sorry, I didn't.
okay, no worries. And it's actually quite a simple question because I don't understand the math. Okay,
If we
so-
keep interrupting you, it's not that simple.
so big picture, I think we're looking at 9 million for a repay on the community fund right? Community center,
We can, yes.
and 18 million for the police station, and 14 million for the fire station. And so that is like 41 million. So if that number is correct, how do we plan to accomplish that if we're doing a bond issue for 25 million?
Right, so the 9 million repay, you can't necessarily, I don't think you can necessarily count that as a linear number because that's gonna refurbish. I think you have to look at it as 25 to get to 33. 25 is for those two things, but because we're repaying in, it just keeps our fund balance the way it is now.
Right.
So it's not necessarily a debit to those numbers as it is much sort of a stabilizing of our current numbers, keeping us with the ability to pay the 33 eventually. I think what you have to look at from my perspective, Paul, is if these numbers hold and you add the community center over a period of 3 years, we're committing $80 million to capital expenditures.
Right.
And I think the best estimate we can get to is sort of without some special math, 25 puts us at a rough zero, without surpluses built in, without some of the donation money, without some grants that are probably going to come for these two
Right.
things.
Right.
It seems to me, to use variance language, it's the minimum relief that we need to get to where we need to be.
So once again, I'm not a financial planner, but isn't the 25 million too low?
Could be.
Like, shouldn't you be talking somewhere in the realm of 40 million for everything that was discussed tonight?
Could be.
Okay. So I just didn't understand that. And thank you for trying to shed some light on it. And actually just have a second, more of a comment. I think the 4 years, did you say a 4-year spend for this money?
Roughly.
I think that's
4 to 5.
aggressive.
4 to 5.
I think it's 5 to 6. But, that's not knowing what you know as far as what you're going to need in the way of NPDES permitting. But I heard you've got a brand new site, so you've got a year of permitting just for NPDES, right? And not knowing how the fire station is going to be built off of the existing police station, but making the assumption that the police station needs to be in their new building before serious construction can start on the fire station. Talking about a year for each building, you're probably looking at more like, no sooner than like 29 to spend all this money.
I think I misspoke. I had the police last at October of 28, Paul. So I'm about
Okay.
2 to 4 months off.
And then you need like another probably 18 months for the fire station after
Well,
that.
One of the things Mike and I talked about is possibility of temporary office space
Okay.
here at Grange Park. Maybe the police move offices here for a little bit.
We'll also have the community center up and running too.
Well, and anyway,
But
that's
I'm
your job.
trying to
That's,
shave those
yeah.
months off. But yes.
So, okay. Thank you.
Right. And then on the big number, Paul, we have up to 60. We could try
Right.
25. And if we need
Right.
more, we need more. And we'll do a reissue at that point. We can also refinance in 8
Right.
years and do that as part of a refi.
Okay. And I'm following your logic on the need to have a good cash fund to get the good rates. I understand that. That's ideally how we all do our own personal financing. You know what I mean? So I get that. And I get that it's, what is it, $500,000 every time we're going to do a new bond issue or whatever.
I think that's a little high, but it's.
I wish it was. It's
Oh.
based on the size of the street.
Okay.
It could be $50,000 to $100,000 each time, maybe a little
Okay.
bit more.
The soft costs are probably 120 or so, and then there's some other. So depending on how much you borrow, we're talking about 200-ish.
Thank you. So, of course, I had the number wrong. So I'm getting all that. I was just trying to better understand how, and I have to admit, I still don't really understand how the 25 is going to cover like 41-ish in what we are thinking of spending in the next 5 to 6 years. So thank you.
Thank you, Paul. Appreciate it. I don't know your name, or otherwise I'd call you by your name.
David.
David, nice to see you, David.
Been
Welcome.
in township since 1990.
David,
Wanna-
your last name, please?
Oh, Wolfson, Wolfson.
Thank you.
First, I want to thank you for having this in the open as opposed to last week when you were maybe we do some of this behind closed doors. So thank you for opening this up. Well,
We haven't done any of this behind
No,
closed
this is
doors.
great.
If you
No,
can
I-
tell, we're asking questions of each other that are
I'm
fundamental
thanking
and
you
base.
for that.
So.
It was great. And I just had a little fire in my house, and guys came out right away. So I'm very thankful for our fire department. The chart that Jamie put up had a sources and the uses chart on it. I think that's exactly what we could use here. I think that's what Sonny was talking about. I think maybe that's what Mike was talking about. We're listed year by year. What are we going to use the money for? When? Where? The discussion we were just having was good because it said, okay, maybe we need 2 million now. Maybe we need 20 million a year from now. That's helpful to know because if it costs $120,000 every time you issue a bond, you can save a lot of money if we don't borrow the whole thing right away, right? Because I think the 25 million was $1.8 million a year cost. So
Well, that's principal and,
principal,
yeah, that's everything.
correct. I suspect
So it doesn't cost, that's not the whole.
yeah, correct. But I don't know the split. I'm assuming most of that's interest in the first year.
It's just, yeah, it's
It's
just like your
amortized.
mortgage.
It's
just
a
like-
mortgage,
It's
right?
just like your mortgage.
Exactly. So most of it's going to be interest in first year. So you can save a lot of money by sort of deferring, taking the whole thing out right away. So maybe borrowing a couple million to get sort of the engineering studies done, so you can firm up estimates, and then in a year or two from now, take out the rest. My guess is if you look at the cost benefit of that, it'll actually pay out. So that's point one. Point two is we're going to be obligated. If we pass the $25 million bond, we would be obligating taxpayers to pay like $1.8 million a year for the next 24 years, right? Sometime during that time frame, we'll have a time of very bad economic sort of conditions. So is there a contingency plan? What happens when we can't collect the kind of tax revenue that we have right now? And we still have to pay off the debt. What happens? What are we not doing? What's the plan for that?
Well, and it's funny because I don't like answering questions with questions, but in that scenario, and we don't have an updated police station, and we have people leaving the township because as we grow, we're not able to provide the same services. What are we doing then too? So while it's fun to imagine, and I'm a lawyer, this is what I do for a living, is imagine the horrible scenarios. I don't paint rainbows and sunshine. I paint thunderstorms and tornadoes. And yeah, we got to figure out as we do this, what happens if all the businesses move away on day one, or if we have a explosion of turmoil. I don't know if anything's going to be the same if we have that. We're going to have much bigger problems than the debt service at that point. We're going to have some real fundamental issues in the township.
I would like the community to think about what you just said when we talk about how we want to beat up people about the businesses that are here. We need to treat those people like they're residents, just like we would treat each other. And my point is, we need to do everything that we possibly can to make sure that the business community is just as happy as the residential community. That's one thing we could do to make sure that we have that tax base. Period.
Okay, I'm 100% behind you there because businesses are in large part funding
Absolutely.
townships, which is one reason why we have low tax rates on there. I'm just suggesting we're going to obligate taxpayers to a lot of money every year, and taxpayers are people as well as businesses, right? It's both sides. We just need to think through. I would suggest we have a contingency plan in place that if things go really badly, we have a plan in place to know what's the actions we're going to do before we obligate ourselves, before we obligate taxpayers to lots of money every single year.
So, and I should not be the one to do this, but this was several years ago. But just for reference, a couple of years ago, whenever we did this, the average residential tax to the township was something like $238 a year. I don't know if that's holding or based on the houses that we have and the apartments and everything else that are going in here, but it is uh, low. And
I'm there.
again, going back to the businesses covering, the lion's share of the load.
David, and I'll speak to that a little
Yeah,
bit. I
thank
think, much like Jamie alluded to, this is like a mortgage, municipal mortgage. So when you buy your house, I'm sure some people go to the bank and say, give me all the money I can qualify for. Other people's are a little more conservative to make sure that they have some reserves in the bank. If they lose their job in 20 years, they hopefully don't lose their house. We would do the same thing. If there's an opportunity to refinance that mortgage or refinance that debt,
Thank you.
we'd take it. While times are good, we manage our money wisely, pay off some of this debt, lower that debt service, don't take it the full term. There are those options, and I feel pretty strongly that the staff here would be on top of that.
Yeah. And I'm with you. There are options. When things are good, there's lots of options. When things are not so good, there's less options.
Right.
So
And-
I'm like, no, the only caution is please, before you sign on the dotted line, think through the worst case sort of scenario, because chances are they'll come true.
And that's where you need your reserves. And that's why I'm not asking them to spend it down to nothing.
Yeah. One last question. In the PFM, all the charts. The first line is always life cycle, like life center, lifestyle center, whatever. And that's why it's confusing, because it seems like the debt is always tied to that. And then on the other hand, you say, well,
Your
we don't.
capital's capital.
Right.
You're doing a lifestyle community center right now, which is you're paying out. So you have multiple projects they're planning for, and the ordinance that was passed. Sorry, jump in.
Thank you, bro.
Yeah, the ordinance that was passed allows for capital needs
Right,
to spend.
right.
So yes, we are talking about the active projects. We are not actively building a fire station, police station, public works facility, municipal building. This is what we're talking about. It is open each for other things. So there's a tax reason, there's a state law reason, and then there's a reason to borrow money. And I always talk about the lifestyle community first, even though we don't plan on spending the money on that technically. It is part of the big picture of long-term planning.
It's also the basis on which the 60.5 that we're borrowing is
Right, yeah.
structured on.
Right, yeah.
So, and part of what from Thursday to today, I wanted to make clear, and that's why we sort of have talked about it this way, is that the numbers based on the community center, but the spend is actually that we're talking about is a forward-looking idea to something else.
Yeah, no, it's confusing.
Yeah, I get that, and I that's why I tried to make it a little bit more clear tonight.
Because, thanks. Because the
Lifestyle center is
lifestyle
tough. I
center,
gotcha.
it's a sunk cost. It's already done. So that should have no bearing.
I wish it
on
were already done.
actions going forward.
It's not done yet.
Well, it's pretty far up there.
It
And
is,
my
yeah.
guess is you've spent a lot of money
Yes.
buying stuff, right? So my guess from a cash flow standpoint, you spent a lot of it already.
Yep.
So I'm just saying that should have nothing to do with what we do,
Right.
what we need going
It's just
forward. It was a convenient number.
right, and the cash flow chart that we use is sort of it can be if you squint and sort of cross out community center, it's still similar to what any build is going to be: cash in, cash out, money in, money out. So it's still helpful, but for your purpose for the question, it's based the big picture is based on the community center because it's an active build. It got us to the 60.5 outer parameter. We're not borrowing that much money,
Right.
and it's a general fund obligation. It's not just for the center. This is for other things, and it's going to be planned to spend on other things. And David, I also want to, while I have you, thank you for the email that you sent. I want to make
thanks.
sure that we acknowledge this publicly that you sent one to us. I know all of us read it. an opportunity. It's an opportunity for me to thank you for engaging that way, and I appreciate it. And while we're out, feel free to use our emails to send us questions, and we'll try to. We didn't send a response because we had this coming. So,
We're here.
but we're not afraid of responding to the public, so I appreciate it. I wanted to make sure you knew that. I appreciate it. Other public questions or concerns? That's fantastic.
Thank you for doing that acknowledgement.
Anything else from up here before we sort of move to the, if the 25 is right, or if we want to amend the motion to a different number, which we can. I guess that would be my question to you, Sonny, as we start this. Is the motion was made as 25. What do you want to do, if anything, with that? Are you comfortable there, or are you never going to be comfortable to this extent? And I just not meaning to pass judgment on it. I just want to know procedurally how we want to move here, because we're comments closed.
It's not that it's never going to be comfortable. I don't feel comfortable making this decision in a vacuum without a lot of the analysis that I'm asking for. So it could be that the 25 number is the right number. It could be that the right number is 18, or it could be 30. I don't know, because I think a lot of folks, I'm resonating with a lot of what other people are saying, is that we just need to, we shouldn't be calculating stuff during the meeting, trying to figure, hey, what's the right number? I mean, that's kind of representative of what my concern is we don't want our finance people to have to kind of figure this on the fly. Let's take some time. It could be another month. If, you have all the stuff that's in the Word document, build a financial model to figure out what exactly you need. And it might be that you might need more. And there is you can do trade-offs, right, between the cost of bond borrowing and the cost of carrying interest, and figure out what the break even is. And then you can figure out what the timing is. I mean, I know the math. I can do it myself, but we just haven't done the math, and that's where my concern is. I'm more concerned about the process, not the actual action.
Okay.
That's where I am. That's why I'm not comfortable now, because I don't feel like we've done that. And once we do that, if the number tells, if the number shows us this is the number and this is the time, I'm all in. I just haven't seen that. That's where my concern is.
So from a procedural perspective tonight, and I don't want to put words in your mouth, and I want to make sure that if we stuck with a motion of 25, you're not comfortable, not with the idea, not with eventually that number, but you're comfortable with a vote tonight on a number.
Yeah, because even the number, exactly, because even the number was, well, let's just pick something in the middle. That's not how we should do things.
Okay. So let me ask it this way then, before we move to the next thing. Bob, from a township perspective, and I guess Bruce from a township perspective, I assume that you have worked through some of these numbers and you have a recommendation of comfort level based on the current math and the current model as to what this bond should be. Can you let us know what the professional staff of the township has worked together to figure out what the number should be, could be, or absolutely can't be tonight?
I would do 25,
And that's based on what?
based on our estimated reserves at the end of 26, the anticipated spend over the next 12 to 15 months. But I will caveat it with, let's look at what our reserves, what our cash carryover will actually be 25 into 26, what the estimated will be 26 into 27. It's probably going to be in the $5 to $6 million range. At that point, that's when we could consider an additional 5 or 10.
If the
I
25 doesn't cover what we needed to cover.
And it's going to be close.
Okay. Jim, what do you want to do?
I'm in agreement with Bob.
So you're okay with the motion of 25? Anybody want to help me with this decision? Of course you do, Jack.
Sat here all night and listened. I've heard Sonny said he trusts his staff. The staff entrusted this gentleman to come up with a number, and they didn't pull it out of the air. If we trust our staff, and we've obviously heard from
the police, fire, public works, they know what they need. They put that into a number, 25, 50, whatever the project is. If we trust their staff enough, you should be going with that. That's my opinion. Thank
Thank
you.
you, Chuck. Yeah, Mike.
Something Dave said earlier resonated with me. If you had to do it in two lumps, let's say 10 and 20, whatever it is, it costs you an extra $120,000.
I said 200.
Whatever the number is, okay? The borrowing the money, the delta between what your rate is and what you're going to get in the bank by putting that extra money in the bank is a certain cost, right? So if you do the math, and I can't do it in my head right now, but you should be able to figure out at what particular time, maybe I borrow 10 now and 15 later. And even though I have to issue it twice, okay, and spend that extra 200,000 or whatever it ends up being, where's the break even point? What is that? It's really, to me, it seems like that is a prudent thing that you need to weigh into the decision on what you need to vote for today, whether it be 10 million. I see Bruce shaking his head and agreeing. Okay, at this particular point, that is an important fact that you need to put into play at this point. So that's didn't help you with your answer, Jeff, but it's something to consider that at some particular point you'll pay back that extra refinancing, the second bond issue.
Let me just add one thing to that, and it's a very good point, but I'll add another benefit to it that you may not have mentioned. It's also, it hedges your risk, right? Because we don't know where the markets are going to go. So let's say that let's say interest rates go down in 6 months, right? And now we're locked in at a higher rate, or a year from now. I mean,
They
as
go
long
up
as
in 6 months.
it hedges your, it could go
Say
both
it go
ways.
up in 6 months.
It goes both ways.
Go the other way.
Yeah.
So I don't know what the point is.
The point is you don't know, and if you split, if there's a benefit, I don't know, I don't know if you play the stock market. I do. I never put everything in on the first buy. I don't buy everything at once. I wait because I don't know when the market's going to be, right? You hedge your risk, you hedge your bets. If it goes down, and then you go in. It's sort of the same thing as with the bond market. And all I'm saying is, if there is a break even, but then there's also a benefit of a risk. Now, you talk to a lot of people. People tell you different things. One guy thinks the interest rates are going to go up. Personally, I think they may go down. Right now, there's even right now the Fed is contemplating a reduction, and the president's pushing them for that. So if that happens, you might be better off. That's what I'm saying. There's another benefit to taking 2 bites instead of 1, and that is that you if you're not in uncertain times, you're hedging a little bit.
Right. So, nobody knows which way the rates are going to go, but you look at the yield curve now at this particular point. Okay, this is an important point. If you're going to borrow money, okay, for a longer term, you pay more for it. It's the opposite. You put your money in a CD now at this particular point, you get a better rate for 3 months CD than you do for a 3-year CD. Why is that? Because the banks think that the rates are going to go down.
There was an inverted yield curve last year that was more prominent. Right now, it's a basis point or two. Long-term rates are higher than short-term rates. So our 25-year rates of 4.75, and the short-term rates about 3.2. Okay. The question about how much should we do 10? We should have done 10 a year ago. That's when you would have made the decision at that time to split it up. We're at a point now that you have capital needs that you intend to do potentially in the next couple of years. I think it's a different conversation. So the benefit of doing 2 $10 million issues, what we talked about in some previous meetings, was bank qualification and things like that. We're at a different point right now where the projects are coming faster potentially. So doing 10 and coming back in 6 months, you just don't get the benefit of it. That's my opinion.
You'd have to have a significant time. You don't want to do it because you're not going to get a lot of value between the differential mortgage rates for 6 months, you're never going to be able to recover the 100.
But part of my point was, we know there's going to be millions just in engineering and management before we even get out to bid or buy anything. You know, thank goodness we bought the properties already, but, you know, it's not like we're going to sit here and not spend anything for a year or two. We're talking months to spend that
Fair enough.
spend.
But we just made a decision to spend $750,000 to buy a property. Okay. Didn't we just make that decision a month ago?
Yep.
Okay.
Knowing,
So-
but there was thought behind it.
Yeah.
There was
I'm
serious thought
saying
behind it.
some of these things come, you know, you have an advantage, you've an opportunity. Now's the time to jump on it. Okay. But it didn't stop you from doing it, right? You didn't have to.
If we didn't have the money, it would have.
Sure.
If I didn't have the money, it definitely would have stopped me.
But I
which
think
is
that's
part of what our
Sonny is
point
asking
is.
for. Lay out the whip curve.
but
We
I
call
don't
it
know-
a
I
whip
don't-
curve.
Yeah, but I think, and to give you a little insight to where my head is, just to be open about it, Mike. What Jamie said is the part, and what you agreed to is the part that concerns me about doing a number that may be insufficient.
Yes, right.
Right? If we need to do a double, we're not really saving amount of money. If we did 15 and we have to come back and 25 was the right number, we have to do 10.
Right.
We might save a little on the interest rate, but it might be gobbled up by the fact that we might not get a great rate on the second one because our spend is our rating went down. Plus, frankly, it's just a pain in the ass more than anything else to have to do it again. I have this conversation
Sure.
again, and I'm a little bit concerned with making sure that we have enough. If we borrow $1.2 million too much, we can start the defeasance process, bring it back in, and we can cover ourselves on that. These are
There's a cost
callable
for that.
bonds.
Pay it off.
And that's the part that we talked about on Thursday, is making sure that there is, after 8 years, 7 or 8 years, there's a early prepayment process that we can go through.
Yeah.
I'm just concerned if we're going to vote to do something tonight, if we're going to vote to issue any number tonight, I sort of want to make sure it's the right number. I'm going to edge higher than 10. I think 10 is the wrong number. I think 10 is not going to get us
Right.
to where we need to be. 10 is going to be a Band-Aid that we're going to have to fix. 25 seems like it's very close to the number based on just sort of generalized math. It's very close to the number. And if it's short a couple $1 million, we've got some other resources available within that we're sort of not talking about, but are there. You know, the RCAP money and some other grants that are going to come through and some other donations that are going to come through. That gets us to that cover that I'm comfortable with. I'm just
Right.
you know, as we're talking through these things, I get all the concerns, right? I don't make decisions in my life, period, without talking to my wife first, because she's far smarter than I am on most things. And I hope she heard that.
It's on YouTube.
And she had the same concerns generally that Sonny's raising, that everyone raised. If you don't need it now, why borrow it now?
Right.
But this is a different scenario than I'm anticipating needing a car. So I'm gonna borrow the 50 now as opposed to borrow it when I buy the car. We've got costs that we have to build in. We have our rating that we have to build in. You indicated, Mike, and I appreciate it. It's a gamble. I think that's the word you used, is we're taking a gamble. And this is not my money. Right? This is all of our money. And I'm
Right.
very appreciative of that. But where I'm sitting, where I'm thinking, now's the time based on a number of different factors. And 25 seems like the number for me. It's not, I put it in the middle, Sonny, because it was easiest to phrase it that way. To suggest that I have not thought about this since Thursday or for the last 6 months, I think is absurd. But we are, you know, and I've asked Bob, and Bob's considered this number for at least the last 6 months since we started. And we talked to Jamie before we even started the community build as we were thinking about this number, right? There's a lot of more thought than just showing up and having Bruce write some numbers on a piece of paper. We've all had this contemplative thought before. And it feels like we're getting to a point where we need to make a call. And I'm just giving you insight to where my head is.
Well, thank you, Jeff, for saying that, because it seems that there was a lot of discussion and, you know, back of the envelope calculations being done right now.
This has been a long time coming.
So
and
that's
Jamie,
what it appeared to me.
If you notice the presentation he made, the dates are way out of date because I think you were here in 2024.
Yeah.
Yeah, I wasn't here in 21, so we're not worried about that. But
Okay.
But this bond conversation's been a year in the
So,
making.
so I didn't help. I'm
No,
sorry.
you helped a lot, Mike. Everyone helps.
But what, it's just the issue of, at some particular point, there is a payback for doing a second issue.
I get you. I got you.
Okay.
I just want to be clear. I was not proposing that we do a 10 million bond and do another 10 million. I was just saying is that when we lay out the financial plan, we'll know better what it is and what we should do and optimize. To me, it's an optimization problem. I'm an industrial engineer. This is how my brain thinks. And when I look at that, I want to lay out everything else and optimize the amount and the timing. And that's why I'm not ready right now, because I don't think we've done that. That's all. And it's not a matter of faith or having trust in people. It's the math. I just want to see the math before we move forward. It's the proper financial process that I'm used to following.
I get that. So it's 8:50. If I could trust the clock. Jim told me never to trust the clock directly in front of me. We've been at this for an hour and 50 minutes on this, and we do have one minor piece of business. So what I'm going to do is I'm going to call the question. I am not in favor of amending my motion unless anyone else wants to make the motion to amend it. The motion on the floor, I put my stuff away, is authorizing the township manager to execute all paperwork necessary to complete the sale of bonds in the $25 million.
I seconded it.
Okay, so we'll call that a question and move to a vote. All those in favor of the motion to authorize a $25 million bond signify by saying aye.
Aye.
Aye. Any opposed?
I oppose.
2-1, that passes. Again, thank everybody for coming and listening to that conversation, engaging in that conversation. It's important to make sure we hear all sides to crystallize the way we think. And it's important to make sure that everyone's voice is heard. We do have a minor motion additionally on the agenda tonight, which is a motion authorizing the advertisement of public workshops to review certain draft sections of the Upper Macungie Township zoning ordinance rewrite. Bob.
Thank you, Mr. Chairman. The board, over the next few months, will be looking at the zoning rewrite, and they're kind of breaking it apart.
Thank you, Jamie.
Breaking it apart in sections, so it won't be so much to digest at one public hearing. So basically, to do one advertising and be done with it. These were the tentative dates. So we'd like the board to confirm these dates at 5:30. The workshops are expected to be an hour, but
Give us a break.
it gives a little break, or it gives you a buffer should they run long.
I'll make a motion authorizing the advertisement of public workshops to review certain draft sections of the Upper Macungie Township zoning ordinance rewrite to be held at 5:30 p.m. at the Township Building on Thursday, July 3rd, 2025, Thursday, August 7th, 2025, and Thursday, September 4th, 2025. Is there a second?
I'm not seconding it. It's my last 6 months. He's gonna run me ragged.
I need
Then you're gonna do budget workshops on top of this?
Can I ask what is going to be covered in those?
Well,
What are the
let's
general topics?
there's an idea Sunday for that. I want to get
Okay,
into
go
that, but
ahead.
I need a second to get the motion to be on the floor. To have
I'll
that
second
saying.
it.
Thank you, Jim. All right. So just to be clear, these are the dates: the July 3rd, August 7th, September 4th. These are township regular business meetings of the Board of Supervisors.
First Thursday of the month.
And I know that we talked briefly. I'm not sure if it's on or off the record on Thursday. There's really no record of a township meeting except YouTube. The July 3rd, we're going to be discussing the sign section, as well as probably having a little bit flow over from the definitions in the use table.
It's my yes, the sign articles or the sign chapter is going to be discussed at the next workshop. And I believe there's going to be, I have a meeting tomorrow morning to go over this, but I believe there's going to be some additional discussions with the use table.
Since we didn't really get to we got to the map on Thursday. We didn't get to
Right.
the use table.
So yes, the definitions and the use table.
So
carried
Thursday,
over.
Thursday, July 3rd will be signs, use table, and definitions.
Correct.
And then is there a plan for the August 7th?
We'll know better after tomorrow. I can let the board know, but we're seeing which direction we need to go and what's completed. There's different entities,
And
people working on different.
And I believe the
sections.
initial plan, Andrew, correct me if I'm wrong, was that the Thursday, September 4th, there's going to be a whole one dedicated to the mixed use ordinance because that's
That's
a
the
big deal,
biggest
but we need to
change,
push
and
that
that's going to
furthest
need
back.
the most discussion.
so
I'm not committing to the meetings until I see a full agenda, then I will commit to the meetings.
with all due respect, So September 4th, I think we're going to tentatively call the mixed use because that's one that we need a little bit more time to get to, and that's going to be a
Yes.
big piece. So Thursday, August 7th, we're going to call it potentially setbacks, dimensional issues,
That's being worked on.
and I
yes.
don't think we're changing any
Administration.
process
We're
stuff,
gonna have
some
to get to as
administrative
well.
stuff. Okay. So Thursday, August 7th will be a little bit of a mixed bag, but it will be mostly focused on dimensional issues.
Yes.
Sorry, just to clarify, when you say signs, you're talking about building signs and
Building signs and all kinds of signs. It's going to be much different than it is now. There's going to be use of a lot of graphics, types of signs. It's going to be much more comprehensive than it is now, whether there are signs on buildings, signs in front of buildings, standalone
Okay.
signs,
okay, all sorts of
all signs.
And omens. We're going to talk about omens too, right?
I'm sorry?
Sorry, I'm being a
Yeah.
smartass. All types of signs, including omens.
Yes.
That's me being a smartass. Any other questions about those 3 dates?
Wasn't any funnier the second time.
Can you want me to repeat it again? I was talking about omens, which is a kind of signs. How'd I go? Funnier the third time. Any questions from the public about that? All right, we're going to call question, move to vote. All those in favor of the motion to authorize the 3 workshops at 5:30 on the Thursday meetings in July, August, and September, signify by saying aye. Aye.
Aye.
Any opposed? That passes. Thank you, Bob.
Thank you.
Public comment courtesy of the floor. Anybody? Awesome.
Make a motion to adjourn.
Motion to adjourn has been made. I will second that. All those in favor of the motion to adjourn, signify by saying aye.
Aye.
None opposed. We are adjourned at 9:55 p.m.
8. Ooh, you scared me.
8:55 p.m. 7:55 p.m.